Greetings, friends. This is Oleh Ivchenko, head of Pareto Company. This is a new episode of Pareto Point, dedicated to transfer pricing and controlled foreign companies. Today in our focus, the government of Ukraine has approved a draft law on the ratification of the Convention on the Elimination of Double Taxation with Australia. The Court of the European Union has recognized Belgium as having violated the requirements of the EU tax directive and the European Commission's proposals regarding the taxation of digital companies. I will tell you more about all of this in detail. Let's get started. The Cabinet of Ministers has approved a draft law on the ratification of the Convention between Ukraine and Australia on the elimination of double taxation and the prevention of tax evasion. The Convention defines exactly how the right to tax income is distributed between the two countries if a company or an individual receives income abroad. It also sets maximum tax rates, dividends 5% provided that at least 10% of the capital is owned, interest 5% for financial institutions, and 10% in other cases, royalties 10%. A separate provision is made for the exchange of tax information between countries and a mutual agreement procedure for resolving tax disputes. The Convention will enter into force after it is ratified and the internal procedures are completed by both parties. The document has been submitted to the Verkhovna Rada of Ukraine for consideration. The Court of the European Union found that Belgium had violated the requirements of the EU directive on combating tax avoidance and supported the position of the European Commission. The essence of the case concerned the taxation of controlled foreign companies, CFCs. According to the directive, the state must allow the taxpayer to credit the tax that the controlled foreign company has already paid in another country. The court emphasized that this provision is mandatory and does not allow for exceptions. Countries may only determine the method for calculating such a credit, but they cannot refuse to apply it. The court also noted that this rule applies regardless of which model of controlled foreign company taxation the country uses. In March 2018, the European Commission proposed new rules for the taxation of digital business in the European Union. This concerns companies that operate online and can earn significant income without a physical presence in the country. The first approach involved changing corporate rules. It was proposed to tax profits where the company actually interacts with users even without an office or representative office. To this end, the concept of digital presence was introduced with clear criteria, including revenue volume, number of users, or contracts concluded. The second approach proposed a temporary tax of 3% on revenues from certain digital services, including online advertising, intermediary platforms, and the sale of user data. A final decision at the EU level was not made at that time. Some countries introduced their own digital services taxes, while others decided to wait for a coordinated international approach. That concludes today's episode. I, Oleh Ivchenko, and the Pareto team thank you for your attention and for staying with us. If you found this episode useful, support us with a like and share it with your colleagues. Subscribe to our newsletter on LinkedIn and read analytics on the Pareto website blog. All the links, as always, are in the description. See you in the next episode of Pareto Point.